Morning, everybody. This is Chris Robinson, Robinson Ag Marketing. Today's pre-opening grain and livestock comments for February 10th. It is USDA day. Last month on January 12th, we had some pretty surprising market moves. And again, nobody predicted them. And that's what I wanted to just cut off here real quick. Nobody is going to tell you, yeah, we're going to rally or break 30 cents in corn. I would rather hate the USDA and be hedged than hate the USDA and be unhedged, right? Feel free to make your own decisions about the USDA, but the simple fact is you can get very cheap protection, and that's all a hedge is. It's price protection. There's a cost associated with it, but fortunately, it's not that expensive. You can get something on here for a week. You can get something on for 11 days, and it's just defense. And 90% of my clients are farmers and producers. So you're always bet long. So you want to keep the upside open. Or if you sold something, who am I to say that we can't have a reversal of the last USDA report? I've been doing this for 32 years. I've seen it before where one report sets in a low and then we digest for 2 or 3 reports. So I don't join in the game of promising and predicting where these prices are going to go. I just want to make sure that if we do rally, which is what farmers want, right? You don't have the works gummed up above by having oversold anything or have a bunch of calls sold up there to pay for a couple puts. On these reports, you can defend yourself for literally pennies, certainly less than a nickel for corn, and certainly less than a dime for beans, certainly less than a dime for beans and even wheat. So get a hedge on. You might not need it. We won't know until 11:30. The report comes out at 11. We'll see where we are by 11:30, and then of course where we are by the close. So um, I'm sure most of you will forego at doing anything, but again, I think if you have the opportunity, if you have the means to set a hedge in front of these reports, you should consider it. Maybe you don't do 100% of your risk. Maybe you don't do 50% of your risk. Maybe you do 25% of your risk. But uh, you certainly have an opportunity to defend yourself. It's like walking into a bar and, is it going to be a knife fight or a gun fight? Or is it going to be an ice cream social? I don't know. Be prepared. So that's my take on the USDA today. Overnight, March corn was up a penny and a half, a 3 cent range. In the beans, we had another 11-cent range. Couldn't take out 17 and a quarter. We settled at 14 and 3/4. That is up 4 cents. New crop beans, which is I think what we're all most concerned about. Guess what? Wake up call. We're sitting at $11. That's last time I checked. That's a lot better than where we were at the bottom, down at 10.55. It's not 11.30, but it's certainly I think most people. I think you'd be hard pressed to find somebody that doesn't make money at $11 beans on the board. Maybe some of you need 17. I don't know, but um, that's something that you can protect right now in front of the report. And why would you want to do that? Well, what if it's bearish? What if the next 2 or 3 months we grind lower? Every day the headlines change. One day China says this, one day the president says that. At the end of the day, um, we're going to have to find out if China's going to come back and do their usual purchases from us, which for decades had been we grow 4 billion bushels, and they took 1 billion bushels. That old agreement has gone out the window here in the last couple of years with the new political scene we're on. But as if I'm a farmer or producer, I want to make sure that I certainly don't do anything that, and you don't have to spend a ton to defend at the money puts. You really don't. You can do 1090 puts. Um, and again, why would you do that? Well, you want to be protected in case, this is February 10th. If April 10th, we're, 50, 60 cents lower, you don't want to look back and say, oh, well, I could have spent, 8 or 9 cents and covered some of this revenue. That's really what it comes down to. Now, the flip side is you got to be willing to lose the 8 or 9 cents if we rally. There's no solution to that. So it's like you're gonna go skydiving and you know you can buy life insurance for the skydive. That's what you sort of do for these reports. You've got a risk, you have a known risk. It's happening today at 11 o'clock. Feel free to hedge or not. In the wheat, a 4 cent range overnight unchanged. March Chicago wheat sitting at 528. Again, the market there is really trying to create a bottom. We've been at about a 40 cent range here for about 6 weeks. If I'm long wheat in the bin, I'm not worried about $6. I'd love to sell it up there if we get up there, but I am worried about sub $5, and we're at 5.28. So you could have a defensive put down there as well if you've got a bunch of wheat in the bin. Now, if you're an end user, right? If you're an individual or a company that uses a lot of wheat or corn, I don't know why you would go ahead now and start buying cheap calls. They're like buying scratch off tickets at the gas station. I mean, you can buy calls way out of the money for very very cheap, and those would pay off if we had some sort of weather issue, some sort of drought that nobody sees coming. And like I said, I've been doing this for 30 years. I can't remember the last time anybody called a drought correctly. They certainly didn't do it in '88. They didn't do it in 2012. And there were years and years and years where there were a couple weather analysts that said, "This is the year. This is the year. This is the year," and it never materialized. So weather prediction, drought prediction, very very hard. However, your best defense against something like that happening, where we get or even like a year like in '08, right? We're going from '07, '08, we went from 350 corn to $8 corn back down to 350 corn. Those types of markets are out there. What you need is a situation and a story that will be throwing kerosene on the fire. Right now, that's not evident, but you never know where we're gonna be 3, 4 months from now. In the protein complex, we're gonna see if cattle can hang in there. You couldn't have get much more bearish news than we've had in the past 2 or 3 business sections, right? I'm not gonna go on that recap all that, but I mean, to have all this cattle coming up from Argentina and to have April fat cattle still sitting there close to 240, and to have March feeders still sitting at 367, if that's not a sign of underlying strength, this cattle market is kind of like the honey badger. It's like, okay, is that all the bad news you can give us? Because it's held in pretty doggone good. So it's giving you a chance again to protect revenue. In the lean hogs, a little bit of a rollover there. I don't know if that's people spreading or not, but there was a gap lower in April hogs yesterday. There's a gap on the chart now, which doesn't get filled until we go up to 98. So we settled at 97 in April hogs. The low of the move when this thing all started was sub 82. So you're still $14 higher than where you were on the low there in November. We traded 81.10. So nobody sells the top. The people that try and sell the top are, consistently. First of all, they're frustrated. Second of all, I think they're missing the point because the whole idea, I think, for marketing is to try and catch the meat of the move. Nobody sells the absolute stone cold top. I think the need for some people to be able to say yes, I sold the top, I think it produces a lot of bad outcomes because again, it's super, super, super difficult. Even just from a commodity trading standpoint, professional commodity traders, if you take 100 of them, 97 of them, or excuse me, 93 of them will be doing something different a year or two later. 7% made money consistently. So it's very, very difficult to be a successful speculator all the time. That's why you, as a farmer, what you need to be doing is saying, all right, I realize this. I'm a long speculator all the time. That's my business decision. So your marketing plan, I think, needs to be built around defense until you make a good cash sale, and then looking for opportunities to re-own those cash sales if you want to stay in the game. And a situation like that would have been like if you've been in a rancher in the past 2 or 3 or 4 years. What if every time you sold 3 pot loads, you re-owned one of them with a call option? That would have been a great hedge. So hedges aren't always about defending the bottom from falling out. Hedges can be about re-owning sales after you make the sales. All right, I'm Chris Robinson, 312-638-8868, robinsonagmarketing.com. If you're not getting my letter, sign up. If you want to talk about marketing strategies and defensive strategies, give me a call. And we'll see what the USDA says today at 11 o'clock. Take care.